Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Neeraj Shah and you're watching Indian Open. Let's go straight to the headlines at this hour. 6 people died and over 30 people were injured as a portion of the foot-over bridge collapsed near the CST station last evening. India Investment Trust, sponsored by Canadian investor Brookfield, will buy Mukesh Ambani's privately owned East-West pipeline for 13,000 crores. Market regulator SEBI orders 2 relief firms to recover loans worth 2,300 crores that were diverted to erstwhile promoters Singh Brothers and 21 other entities. And 108 economists and social scientists call for restoration of institutional independence and integrity to statistical organizations amidst concerns over political interference emerging in India's economic data. And the UK Parliament voted overwhelmingly in favour of Prime Minister Theresa May's plan to delay the impending Brexit. The current deadline ends on March 29. Well, let's take a look at the trade setup for the day. Two pieces of global news, one centric to EU and UK and one for the world at large. Firstly, the drama continues in the UK. The Parliament votes in favour of delaying Brexit. So it was a much needed reprieve, if I can use that term, for Theresa May yesterday after a string of defeats that she has had to endure. She's now finally won the vote from the UK Parliament to delay Brexit in the current shape and form. So that's the first piece of global news that emanated yesterday. And then Donald Trump, in a series of mentions, spoke about how it will take about 3 or 4 weeks for the world to know what happens with regards to the China trade deal. He spoke in the East Wing of the White House, but that notwithstanding, he mentions that if that one gets done, then it will be something that the people will be talking about for a long, long time. So I'm guessing from the looks of it that Donald Trump is still hopeful that there will be a trade deal, but let's wait and watch how it shapes up. Did that have a big bearing on the world markets? I don't quite know. The US markets for themselves, after a string of good moves for a better part of this week, had a flattish outcome in trade yesterday. No big drama in the Boeing stocks, and therefore Dow didn't react too negatively or otherwise. S&P 500 flat, NASDAQ flat as well. So no big changes out there. Just that the world is waking up to a reasonably strong Asian screen. Nikkei as well as Shanghai up over 1%, Hang Seng up over 0.5%. The SGX Nifty for itself showing a start which is muted. But hey, yesterday was a day of pause. Today could well be a day of pause. We just had a number of days wherein we moved up so fast that it's okay to consolidate for a bit. Just keep in mind what could poop the party, India's party that is crude prices. They continue to inch up higher. I think the production curb agreement by OPEC and its partners led to crude moving even further. So 67.20 now for Brent, and we are inching closer to the $70 per barrel mark. HSBC has a view on that, and I'll talk about that view in a bit. But just keep this at the back of your mind that crude has kept on inching up. The max OI, as far as our trade goes, and frankly, I find it extremely difficult to kind of give a view on what could happen to the market. It's not meant to do that any which ways, but just pointing out a few data points. One, the max OI for the March 28 series, now still stuck at the 11,500 on the call side and 11,000 on the put side. So that broad range is what traders are still betting on right now. These things change, but just the importance of these levels are that because the max OI is 11,500, if you indeed see a move which is substantially towards that level, then the short covering that comes about leads to some further upsides for these. FIs continue to put in money, another 1483 crores. Look at those net numbers for the last 5 days. Very, very strong. And collectively, I was just totaling up the month of March. It's over 15,000 crores. That's net over $2 billion that foreign institutional investors have already put in the month of March thus far. It's a welcome sign. I don't think I've seen this number in a really long time from the FIs. It's only 15 days. If the party continues, then, well, you never know. And as we've been always saying, that's having its bearing on the currency. I would presume that's probably one reason that global investors are bullish on India. And that's one of the reasons why the rupee continues to strengthen. 69.35. This is the highest level in 8 months. Yesterday's move from RBI was expected to bring about some bit of pause or tempering to the currency strength, but that's not to be. Another day of strength yesterday. Let's see for how long does this last as well. However, amidst all of this, what are the stocks to watch out for? That's the key thing, isn't it? And a bunch of them are important. Today, we'll talk about some of these on the show as well. Firstly, Coal India, they've declared the second interim dividend of 5.85 rupees. The record date is March 25th. The total dividend, therefore, this year given by the company is around 13.1 rupees. As of now, if this is the final dividend, then it's lower than what the street was working with. However, Morgan Stanley mentioned that Coal India has the option of announcing additional dividends for FY19 even now. So which way the street reads it is important. Futures trading at a discount. Let's wait and watch the impact on Coal India in the session today. HUL and brokerages have come out with notes on a Q4 business update. I'm guessing the management would have given those updates to brokerages. They're speaking about how the overall consumer demand environment seems to have moderated on a sequential basis, and both rural and urban growth have shown moderation. So this is an important update from HUL. Agam will speak more about it, so I won't dwell too much on this, but this is the synopsis of this note, to my mind. IDBI Bank, RBI has categorized IDBI Bank as a private sector bank with effect from January to 21st. Do watch out for this one. Lotus Labs and Amansa Holdings acquired about 33 lakh shares, which amounts to about 3.1% at 351 rupees per share. Already had a bit of a reaction yesterday. Now that the note is out and now that Amansa Holdings name is out, this could be an interesting one to monitor as well. So let's say Akash Prakash's name typically evokes some bit of responses. Last but not the least, South India cement stocks could be in focus. The Bank of America Merrill Lynch cement survey shows that prices have partially been rolled back in South India, ex the Karnataka region. So this could bring about some bit of movement maybe in some of the cement names in southern base. So Ramco, India Cements and the likes could well be in focus in today's session. However, I reckon mid-caps would be in focus in today's session, as also they have been over the last few days, and that's how we start off first word with today. Yatin Johnson to focus on the Nifty 500 to show just how a handful of stocks have contributed the rally. I take you through HSBC Research's bullish bets on India and why the brokerage house is betting on the Sensex touching 40,300 levels by the year end. Nikki then joins in to talk about why stainless steel manufacturers are not worried about the higher nickel prices. And as I said in my update, HUL, they've struck a cautious tone. Agam Johnson with all of those details. Let's start off with the markets though. The markets have taken a breather in trade yesterday after rallying for 3 successive trading sessions. The benchmark indices for the broader markets have actually shown a lot stronger an uptick. But as we've been highlighting here in Bloomberg Quint, the rally seems restricted to a select few names. Today, Yatin Mota is focusing on the Nifty 500 and one of the key indicators of how the mid-cap stocks are performing to just show how narrow the rally actually has been. Yatin, good morning. No doubt that there has been a rally, but your research shows that it's very concentrated, not just for the Nifty 50, but for the broader markets too.
Exactly, Neeraj. And if you look at the Nifty 500, the top 500 stocks in the country, we have seen a 1,000-point rally in that index since the lows of October. And from those lows of October, we are talking about the current date, which is close to 15 March, wherein the 1,000-point rally which has happened, Nifty 50 has contributed nearly 720 points. So nearly 3/4 of gains, or over 70% of the gains that have been made, as far as Nifty 500 is concerned, is coming from Nifty 50 companies. More importantly, during this period, we saw the Nifty 500 give a return of close to 10%. However, there are nearly 285 stocks which have underperformed the Nifty 500 itself, which means that nearly 285 stocks, or more than half of the stocks, have seen return of less than 9-10%, and that is something which clearly indicates that the rally is not that secular. More importantly, if you look at the 200-day moving average, which is basically a technical indicator and talks about an uptrend or a downtrend in the stock, nearly 279 stocks in the Nifty 500 are still below that 200-day moving average level. And also, more importantly, if you talk about the mid-cap and the small-cap end of the market, there also we have seen a similar trend. Nearly 60% of the Nifty small-cap index is below the 200-day moving average level, which clearly indicates that still a lot of stocks are not in that particular uptrend as optically seen in the marketplace. More importantly, we also talk about the valuations bit, because we have seen that recently the rally which happened, earnings downgrades which happened, we need to adjust for that as well. So if you look at the current PE ratio according to Bloomberg for the Nifty 500 stocks, the current PE is close to 19 times versus the 5-year average of 18 times. So we already seen that Nifty 500 as an index, the valuation is on the higher side, close to 5% premium to the 5-year average. Similar is the case with Nifty mid cap and Nifty small cap, where the premium is even higher when adjusted to these large caps. So Nifty mid cap, the current P ratio is close to 16 times versus the 5-year average and a 10-year average of 13.6 times. So on the valuation front also, it seems that the market is not willing to assign a better multiple to the mid cap end of the market, and more importantly, the kind of earnings that we have seen for the past few quarters has made all of these mid cap quite range bound, and still even when the markets are rallying because of global factors or FI inflows, the flows are probably happening in select large caps, and probably that explains the reason why out of that 720 points that I'm talking about, which came from Nifty 50 alone, Reliance Industries, HDFC Bank and ICICI contributed to nearly 300 points. So the markets or the Nifty 500 rallied 1,000 points. 720 points came in from the Nifty 50 companies, and the balance 300 funds, which was contributed by the next 450 stocks, that was equivalent to the move or the contribution which was made by Reliance, HDFC Bank and ICICI Bank. And you can see on your screens that how Reliance, HDFC Bank and ICICI Bank have contributed to nearly 300 points, the balancing figure of which nearly 450 stocks have contributed a similar kind of thing from the period October 26 to March 13. So from the October lows, really the contributions have really come in from big boys.
Yatin, I'm guessing nowhere are you trying to say that the rally is not real. It's just that we are saying that the rally is narrow.
Yeah.
And while it can happen to the small cap indices because it's such a wide basket that the select stocks rally, the interesting thing is it's happening on the Nifty 500.
Yeah, Nifty 500, and Neeraj, we also looked at mid cap 100 and small cap 100. There also we have seen a lot of stocks, more than half of stocks from both these indices combined are below the 200-day moving average. If you talk about the NSE 500 or the Nifty 500, where usually there is action, there is a flow, there are institutional investors, a variety of trading community, there we have seen that the rally is quite selective, and in select stocks we have seen bounce back. So it's not that the rally is secular, everything is moving, you go and buy and pick a random stock and you expect it to rally just because the market is going up. So you have to be extremely cautious, extremely selective in order to generate alpha or probably benchmark returns, because as I was telling earlier, nearly 285 stocks have underperformed the Nifty 500 despite we rallying 1,000 point on the Nifty 500 from October lows.
I think that's the important point, and Yatin, thanks so much for putting that into perspective. I just want to make one point here. You viewers would probably think that how is it that Bloomberg Quint is getting guests who are saying that there are breakouts, and then Yatin Mota is coming and saying that the rally is narrow. What we are presenting out here is data that has actually happened. That is not to say that there are not breakouts on specific indices or specific stocks, and the future it might look rosy, but Yatin is putting into perspective how the rally has been. So that's the key nature of this piece of research. Fantastic, Yatin. Thanks so much for putting that into perspective. However, that's not deterring some global houses from coming out and raising that bullish bets, as the FI flows have shown. But HSBC Global Research has come out with a note. They expect the Sensex to gain another 2,500 points over the next 9 months. The international brokerage house is basing it on a number of factors, including the recent uptick on earnings, relative valuations, and low exposure to foreign funds. Let me try and tell you what's the rationale that HSBC is giving. They start off their note with a very strong message in the first plate itself on the note, which is saying that it's time for India. That is their first headline. And then they say, of course, that the Sensex target is 40,300 by the year end 2019, which means in the next 9 months, they believe the Sensex could be around the level of 40,300. Remember, with these targets, what the brokerages typically mean to say that before this month, before December, the Sensex could hit 40,300. Doesn't mean it only hit in December, it could well hit before that too. So that's something that viewers need to know. They are basing this on what? Well, they believe that the earnings growth in India is one of the strongest across the regions, and they believe the margin expansion is the key reason for the overweight stance. Now, The factors, as I said, margin expansion is one, strong earnings growth, which they said is the strongest across the region, relative valuations compared to some of the other peers in the region, and then low exposure of foreign funds in Indian equities. I think this is one key thing, and maybe what we're seeing in March is a reflection of that. Their FIs were underweight India, and now they're starting to come into India. A very interesting chart that they have put out as well, HSBC in their note, shows how the earnings momentum for India over the last 6 months, and more importantly over the last 3 months, has shown some signs of an uptick. So they are taking heart from the earnings uptick that they are seeing within a broader universe and within their coverage universe. I think that's the key, that they believe that unlike other people, there is some momentum that is starting to build up, and earnings growth will only pick up in the year to come. They also mention an interesting bit on valuations, and we'll use the whole line out here because HSBC is saying that India always appears expensive if we just look at the price to earning multiples, but their preferred valuation, I quote them, our preferred valuation methods across Asia are price to book versus ROE, cost of equity and growth, and those factors show that value is starting to emerge in India. In our view, India deserves a premium on the back of higher return on equities, but this premium is now rather small. So this is a word of caution as well, but they believe that there is a premium that India deserves on the back of higher ROE, and to their mind, because of other parameters and not P multiples, value is starting to emerge in India. That's the key thing. There are risks, of course, as there are risks to almost everything. But the interesting bit is that in both the key risks that HSBC has listed out, which almost everybody has, they have a big if there. So in elections, they give a risk, but they say that the markets tend to be agnostic to election outcomes unless there is a surprise outcome. They've cited 2004 as the rationale, as the parallel for this. But they are saying, so therefore elections risk, but only if there is a surprise outcome. Similarly, higher oil prices are a risk, but only if crude prices cross the $80 per barrel mark, because according to them, their analysis of the history shows that market is tolerant to higher crude prices as long as prices stay below the $80 per barrel mark. So two risks, but both of them have a event based or have a condition attached to them. In all of this, therefore, they have come out with a list of spaces that they believe will show earnings momentum, and then a list of stocks where they believe they are overweight on, 16 stocks that they are overweight on. But firstly, the earnings momentum and how they believe banks will lead the charge going ahead. And I think that's a consensus view, but they are saying that banks will make a comeback in terms of earnings contribution. So Reliance will do well, maybe SBI could show an uptick, Axis, ICICI Bank, others might all come back too. And therefore, watch out for the banking space. That is the one that could really do well. And you know, when you read notes like this, you know why is it that money started to come into India and why the bank Nifty is doing what it is doing, because that money is clearly finding its way into the banking stocks. As I end this piece, just want to leave you with the 16 stocks that HSBC Global Research has put out as their top bullish bets. So, you know, the stocks on your screen, I'll read out the interesting ones. Bajaj Finance, the target is 3190. Avenue Supermarts, they believe, is 1700, by the way. And not surprising, HDFC Bank is a bullish bet. They move on and talk about Divi's Lab as one of the key ideas too. 1780 is the target price on Divi's Lab. Jubilant Foodworks, they are bullish on 1550. They are bullish on Kajaria Ceramics from amongst the other names. They believe that that stock could nudge a price target of 630. ITC, they are bullish on a 340 target. And then, like CLSA, real estate finds its way into the HSBC portfolio too, with Prestige Estates and Godrej Properties as two stocks that they are betting on. And it's very interesting to see what's happening to real estate. Quite frankly, the government is giving a lot of boost. Brokerages are recognizing that, and global brokerages are now starting to bet on Indian real estate. That is the key thing. So, interesting note. Let's see if indeed we meet these targets or not. Let's move on to the third piece on First Word, and that's on nickel prices. They've been moving upwards since nickel hit the recent low in December last year. Now nickel is a key raw material for stainless steel manufacturers who get impacted by sharp price swings, but they don't seem to be too worried about this sudden rise. Nikki Michandani tells us why. Nikki, good morning.
Good morning, Neeraj. Actually, it's a positive coming in for the stainless steel industry. Just to give you numbers first, nickel is up 24% on YTD basis and is the best performer that we have in the base metal basket so far in this on YTD basis. The prices currently stand at around $13,200 per ton after falling from a peak of $15,750 in June and has recovered from lows of around $10,700 for the ongoing quarter until now. The prices have averaged to around $12,300, which is an uptick of nearly 7% sequentially. Now, how does that help the stainless steel industry? Mainly on account of two reasons. The first reason is that the raw material cost is clearly an immediate pass-through for most of the metal companies, just like stainless industry. And the higher raw material cost actually aids inventory gains because these companies usually store inventories for a span of around next 2 to 3 months for consumption, and also the dealers in anticipation of a stronger demand try and store the final product if they see any kind of uptick in the raw material prices. So two reasons, that's the expectation of strong demand which helps dealers to stock their products, and also the inventory gains because most of these companies have the inventory for next 2-3 months. But if you look at the trend that we have seen previously, these the margins of stainless steel industry in the last 2-3 quarters were actually being impacted on account of a low prices of nickel, which is the key raw material. Again, the same reason, it led to destocking and it also led to inventory loss for both of these players, that is Jindal Stainless and Jindal Hisar. What brokerages typically have to say now for these two companies, they expect the recovery to take place in Q4 given the uptick that we've seen in nickel prices. They expect the margin to improve, and they've also suggested that any kind of government intervention in the form of import safeguard duty, given that there are much of imports coming in from Indonesia, which is impacting the industry right now, would also be a positive if government intervenes and levies any kind of import duty on the Indonesian imports that the company is witnessing right now.
Okay, Nikki, thanks for putting that into perspective, and I of course look forward to talking to you on a bit later on the show as well for Coal India too, but thanks so much for putting this into perspective. The last piece on First Word, and that's on a consumption day. Now we are nearing the end of the financial year, and Hindustan Unilever has updated brokerages on how they are faring so far in the fourth quarter. Agam Vakil joins us with the key takeaways. Agam, no release on the exchanges, but yeah. I think multiple brokerages have written, so maybe HUL has spoken to them.
Yes.
What is the update?
Well, the update is that...
This is for Q4, I presume.
This is for the fourth quarter, and they're expecting a moderation in volume, something that we were expecting the last quarter, but it is now turning up into this quarter. We have to remember that HUL is coming off the back of 5 straight quarters of double-digit growth, where the average volumes growth has been 11%. And this time around, some of these broking houses are putting volumes growth anywhere between 6 to 7.5%. As I've suggested, that this is a little bit of a delay because we were already working up with a little bit of moderation because of such a high base. So in terms of what the brokerages have to say, well, they are suggesting that while rural growth still is a step ahead of urban growth, which used to be at around 1.3 times for the financial year, that comes down to around 1.2 times for the fourth quarter. So that moderation is evident in the rural sector as well. They have, however, said and spoken about the fact that the e-commerce channel, rural demand and the naturals portfolio continues to do well. That said, when it comes to input costs, again, the environment as a whole remains benign. They have seen some amount of inch up with respect to certain input costs, perhaps with skincare and detergents. But for that, the company has already taken certain price hikes through the course of the year, and that shouldn't really impact operations on the whole. We also have to remember that the company has been carrying out its cost of efficiencies plan for a whole year now, and that is something which has played out in favor of the company. This is something that they have taken off from the company's parent, that is the global Unilever LLC. And moving on to volatility input prices, while the company does acknowledge that there will be some of that aspect and elements playing out in the fourth quarter, overall, what brokerages make of the commentary is that there still will be a moderate expansion in operating margins. And finally, an update when it comes to its merger with GSK. Well, the company has received a nod from the Competitions Commission of India, so that, of course, is a positive in the long run.
Okay, interesting. from HUL, moderation sequentially, I presume,
Yes.
in growth. But don't quite know what the numbers could look like. I don't think they've mentioned something to that effect. But remember, a copy around this or a story around this for all of you who want to know more about what HUL has said will be up on the website shortly as well. So do log on to BloombergQuint.com. Agam, thanks for putting that into perspective. That's Agam Vakil, our resident FMCG expert on what to make of HUL's update that they gave to brokerages. As we wrap, first word though, a somber piece of news. 6 people died and over 30 people were injured in a collapse of a bridge last evening. The foot over bridge connected the CST station in Mumbai to the iconic Times of India building and the BMC buildings in the heart of the city.
मुंबई में दुर्घटना हुई थी उस समय सारे फुट ओवर ब्रिज, चाहे वो रेलवे के हो चाहे महानगर पालिका के हो, इनका एक स्ट्रक्चरल ऑडिट करने का आदेश दिया गया था। इसको स्ट्रक्चरल ऑडिट में फिट पाया गया और कुछ माइनर रिपेयर्स कहे गए थे। उसके बावजूद अगर ये पुल गिरता है और इतनी भीषण दुर्घटना होती है तो कहीं ना कहीं ये स्ट्रक्चरल ऑडिट के ऊपर भी एक प्रश्न चिन्ह निर्माण होता है।
Well, rest in peace to the souls, and hopefully the infrastructure of Maximum City improves at a faster pace. That's the basic thing that I think all us taxpayers demand and deserve from any government. That's all that we have on First Word today. A quick programming note: we discuss markets and macros with Devin Choksi of KR Choksi Securities and specific stocks and how they will move. We also get you ICRA's view after the rating agency revised the outlook of 6 PSU banks. Anil Gupta, the head of financial services ratings, joins us. And lastly, discuss the trends in telecom industry and the road ahead for the sector with Rajiv Sharma, co-head of research at SBI Cap Securities. He's put out a note on why Reliance Industries might launch 5G earlier than anticipated. But after this break, a full tilt towards the day's trade.